it almost sounds, according to your note, like you're a reluctant bull here.
I think that it's just important to temper expectations. You know, what let us down in December was really a decline in valuations, and what has led us back up is a re-rating in valuations. During this period of time, we've actually seen earnings estimates come under pressure. So it's not that I'm not enthusiastic, and I don't think that this rally has more legs, but I think we need to think about how the underlying drivers of the rally could shift. And frankly, it's going to be the onus is really going to be much more on earnings going forward than it is on the multiple to drive additional upside from here. So we're having a lot of conversations about preparing for volatility, not putting the cart before the horse, and not expecting this pace of gain to continue throughout the course of the year.
We have significantly, though, ratcheted down earnings expectations for the year, Jonathan. If we have upside, I mean, there's no telling what stimulus in China could lead to, a trade deal in China can lead to, and then knock-on effects when it comes to Europe to a Chinese lift in the economy and then back here to the United States.
Right. So first, I'm not looking for a magic bullet coming out of China. What we are seeing is right now market expectation is that the Fed is entirely done. We can have a debate on that, but the futures market's saying it's over. The futures market's saying that longer term interest rates will edge up a tiny bit, but nothing that's going to be destabilizing. So the yield curve becomes healthier in 6, 12, 18 months, but not in a way which squeezes the housing market or anything else. The China situation in terms of a trade deal looks, not done, but the rhetoric has been taken down a bit. And these numbers, listen, we have this weaker ISM number, but here's the reality. We were running on an awful lot of stimulus over the last year or two. That stimulus is going to be coming off. The ISM is going to be at 53 or 54 for the next year. This is not a surprise. It's part of the story.
I mean, David, that picture is one of a bit of a sweet spot here, right? Where the Fed isn't a threat. Expectations aren't very high for growth right now. And, yields have stayed low, and you're actually getting this kind of dividend push again in stocks. So what can disturb that picture?
So I think, when we think about what could disturb the picture is I think that there's a decent amount in the price right now in terms of resolution on trade with China. I think that if that were to take a turn for the worse, you'd likely see markets re-rate to an extent. We're also, though, to your point about dividends, trying to anticipate that type of less than optimal outcome perhaps materializing and focusing more on sectors like financials, energy, right, where you get a little bit of incremental yield pickup above and beyond that of the index. We think about it as bubble wrapping portfolios to try to prepare for some of those unexpected volatility bounces that we think could occur over the course of this year.
That's largely what has led us higher so far this year. Jonathan, would you stick with what is working, especially when it comes to cyclicals? They've been, industrial specifically, the poster child of the trade war. And if trade war is not going to be much, what other catalyst is there? Right.
So I think there's kind of a next 2-3 month story, and then there's a rest of the year. The market, it looks very cyclical right now. I think that's going to probably work for a little while longer, but ultimately, if I'm right and the economy is going to get weaker, it's going to be in counter-cyclicals that may lead. It's interesting, if you look, there's only one sector, I believe, that's ahead of what its recent highs are, and it's consumer staples, which everyone thought was a pig.
Well, utilities is pretty much at an all-time high.
Okay,
and real estate.
I don't think this thing is going to be as cyclical. So healthcare probably does fine. Technology, that's not very cyclical, so away from hardware and semis. So you have to kind of pick your spots on it.
Yeah. Are you concerned about financials at all?
The interesting thing to me about financials is I think the thesis over the past couple of years has really been one of, rates are headed higher and banks should do well in that environment, right? Net interest margins rise, profitability improves, but you've seen a pretty significant decoupling between the behavior of the 10-year yield and the performance of financials. So from where we sit, we're much more focused on the shareholder yield story and increased buybacks, continued increases in dividends, and the fact that a lot of these names are trading at 1x tangible book value. I mean, you're basically just paying for the assets and getting any services business that's associated with these institutions for free. So I think that there is both a short-term and a long-term case to be made for the banks, and the dividend on top of that, again, provides some insulation against volatility.
Jonathan, you talk about a slowdown, and I guess the market can be built for that at these levels if it's just a slowdown, if it's just a soft patch, or it's just this kind of Goldilocks backdrop. Have we been freed from the end of cycle panic that was gripping us 6 months ago?
Yes. I mean, first of all, we know that trees don't grow to the sky. We know that cycles don't go on forever. But the inflation data we saw with ISM below 50 means that we're seeing less inflation risk. Core CPI has come down. Oil prices are off. Rents are softening up a little bit, which means that the pressure on the Fed and the pressure on the cycle is less. And I think if there's a win here, it's not because the economy is good. I disagree. It's not about what could go right or whether it is. It's simply if the cycle simply lasts longer and it's tepid and boring and uninspiring, you get a much bigger up market without there being anything that appears like it's driving it.
Even with a 12% move in 2 months.
Yeah, but we're still, on average, we're 4 to 5% below those peak levels. So yeah, it's a big move. But right now we have a 16.5 multiple on the market. Expectations for earnings, a whole lot has been made about a first quarter earnings recession, which I think we will just miss, but it'll be weak. But the rest of the year, the earnings will come back a little bit. So yeah, I'm not worried about the bounce in the stock market.
But I think that that's a good point. I think that the softness at the end of last year was driven by expectations of a slowdown at the beginning of this year. Some of this rebound, obviously, part of it's been technical, but part of it has also been pricing in a bit of a bounce in the economy after this soft patch that we seem to be going through. So, the big question to me in terms of back to your initial question of kind of what could go wrong is what does the market start to look at next, right? When we begin to hone in on the end of this year, 2020, consensus thinks a recession's coming in 2020. I agree with Jonathan that this could be kind of a tepid, boring expansion, but if you see those recession fears begin to bubble up again, I think that that's probably going to make the market ride a little bit uncomfortable.